In 2008, millions of people watched their savings, their homes, and their sense of safety evaporate, while a small group quietly walked away richer. Not because they were luckier, not because they were smarter in the way you were taught smart works, but because they saw the trap before the doors slammed shut. And later in this video, you'll see the single moment, one decision, that separated the crushed from the untouchable. Here's the uncomfortable truth. The 2008 financial collapse wasn't just a market crash. It was a machine designed to turn confidence into leverage, leverage into fees, and fees into power. And when the machine overheated and exploded, the people closest to the controls were the first to find the exits. Meanwhile, everyday investors, teachers, nurses, small business owners, retirees were left holding the bag. And the bag was full of things that looked safe, until they weren't. This story matters right now because the same incentives that created 2008 never truly disappeared. They just got better at hiding. If you watch to the end, you'll understand how smart money spotted the warning signs early, what signals they used that most people never see, why the biggest losses hit the people who thought they were being responsible, and most importantly, what you can do to recognize the next trap before it recognizes you. Imagine two people standing in the same burning building. One smells smoke 10 minutes before the alarm goes off because they're near the control room. The other is told everything is fine because the hallway looks normal. In 2008, smart money wasn't magically immune to fire. They were just closer to the wiring, closer to the data, closer to the people whispering the truth behind closed doors. And they had the leverage of relationships, the kind of leverage that doesn't show up on a mortgage application. Let's start with the world right before the collapse, because that's where the real escape began. In the mid-2000s, the economy felt like a party that would never end. Houses were rising in value so quickly that people treated homes like slot machines that always paid out. Credit was cheap. Banks were eager. Mortgage brokers were everywhere. If you had a pulse and a signature, someone could find you a loan. And here's the dangerous part. Everyone believed that because the system was big, it must be safe. That belief was the gasoline. But here's where it gets strange. The most important product in the entire housing boom wasn't the mortgage. It was the story told about the mortgage. Banks didn't just lend money. They packaged loans together, sliced them into pieces, stamped those pieces with ratings that sounded official, and sold them around the world. A mortgage from a street in Phoenix could end up inside a pension fund in Norway. A shaky loan from a first-time buyer could be bundled with thousands of others and magically reborn as high quality, because math said the risk was diversified. That word, diversified, became a lullaby. And the moment risk becomes a lullaby, people stop listening for danger. Now picture the incentives. Mortgage brokers were paid when a loan closed, not when it performed. Banks collected fees when they securitized loans, not when homeowners paid them back. Rating agencies were paid by the very banks whose products they rated. And investors, hungry for yield, begged for anything that paid a little more than boring government bonds. It was a chain of not my problem. And chains like that don't break until they're pulled tight by reality. So where was smart money in all of this? Some of it was inside. Some was watching from the outside. And some was doing something even more powerful. It was hedging. While most people were playing the game as if it was only about winning, smart money played as if losing was inevitable. That's the difference. Regular people were taught a simple rule. Markets go up over time. Buy a house, hold it. Buy an index fund, ignore the noise. That rule is usually helpful. But in 2008, the problem wasn't noise. The problem was a structural lie. And a structural lie doesn't care about your patience. It doesn't care that you're disciplined. It just collapses. This is the turning point. The earliest smart money escape wasn't dramatic. It wasn't a single heroic trade. It was a slow shift in posture. In 2006 and 2007, a small number of investors noticed that the housing market wasn't just hot. It was rotting from the inside. They saw teaser rates. They saw adjustable rate mortgages that would reset higher. They saw borrowers who could only afford the first year of payments. They saw liar loans, where income wasn't verified. And most importantly, They saw that the engine of the boom required constant new borrowing, constant new buyers, constant belief. Because if prices stopped rising, the entire trick stopped working. But here's what nobody tells you. The key signal wasn't the headline price of homes. It was the quality of the loans underneath. It was the fact that the system started feeding on weaker and weaker borrowers, like a snake swallowing its own tail. When you hear someone say, "They saw it coming," this is what they mean. They didn't predict the exact day. They recognized the mechanism. Now, smart money didn't all behave the same way. Some got out early by reducing risk. They sold equities. They raised cash. They shifted into short-term government bonds. Some got out by changing where they held assets, moving away from institutions they didn't trust. Others didn't just exit. They bet against the machine. And that bet had a name that most people didn't understand at the time. Credit default swaps. Think of a credit default swap like insurance on a bond. If the bond fails, you get paid. But unlike normal insurance, you didn't need to own the bond to buy the insurance. That meant you could insure a neighbor's house and profit if it burned down. Sounds insane, and it was, but it was legal. And in 2008, it became the escape hatch for a very specific kind of smart money. The kind willing to be hated, mocked, and told they were wrong right up until they were terrifyingly right. Here's the psychological trap that crushed everyone else. When you're early in a bearish bet, you look stupid. You pay premiums. You bleed money slowly. The world keeps partying. Your friends keep making easy profits. You doubt yourself. That's why so few people do it. It's not just about intelligence. It's about pain tolerance. Smart money often has something you don't. The ability to be wrong longer than you can stay solvent emotionally. And sometimes financially, too. But even for the ones who bet against housing, the escape wasn't guaranteed. Some funds blew up early because timing is cruel. Others were right about the collapse but wrong about the plumbing. How the system would freeze, where liquidity would vanish, which counterparties would fail. This is the dangerous part. In a crisis, being correct about direction is not enough. You need to survive the path. So let's talk about the plumbing, because that's where the real smart money advantage lived. In modern finance, confidence is a currency. Banks lend to each other every day. Funds borrow against assets. Firms roll short-term debt again and again, trusting that tomorrow will look like today. It's like breathing. You don't think about it until you can't. And in 2008, the system stopped breathing. One of the most overlooked mechanics of the collapse was the repurchase agreement market, repos. This is where big institutions borrow short-term cash using securities as collateral. It's a gigantic, invisible engine. If that engine stalls, even healthy institutions can die because they can't fund themselves. Smart money understood something. A crisis is often not about assets being worthless. It's about not being able to sell or borrow against them at the moment you need to. So while the public watched stock tickers, the pros watched liquidity. They watched spreads. They watched funding markets. They watched who was refusing to lend to whom. These are signals you never see on the evening news. And when those signals flashed red, smart money didn't debate on social media. They moved. Another escape route was simpler and quieter. They stopped trusting the ratings. Retail investors saw AAA and thought, safe. Smart money looked at AAA and asked, AAA based on what? Because they knew the rating agencies were embedded in the pipeline. They knew the math models assumed housing prices wouldn't fall nationwide. They knew correlation could spike, meaning everything could go bad at once. And once you realize AAA can be manufactured, you stop treating it like truth. You treat it like marketing. Now imagine you're a pension fund manager in 2007. Your job is to generate returns for retirees. Interest rates are low. Your board expects performance. Everyone else is buying structured products that yield a bit more. The ratings say they're safe. The crowd says you're foolish if you don't buy. And the moment you resist, you risk your career because you'll underperform in the short term. This is the quiet violence of incentives. It punishes caution before it rewards it. That's why everyone else got crushed. They weren't all idiots. Many were trapped. They were trapped by benchmarking, by quarterly reports, by institutional pressure, by the fear of looking wrong while the music was playing. Smart money had a different fear, the fear of being the last one out. But here's the twist. Some of the smartest escapes weren't about predicting. They were about optionality. They built portfolios that could survive multiple futures. They held assets that would still be valuable if credit dried up. They avoided leverage that forced liquidation. They kept dry powder, cash or near cash, to buy when others were forced to sell. What does that mean in human terms? It means while others were chained to the treadmill, smart money kept the key. They didn't just try to win. They made sure they couldn't be forced to lose. This is the turning point you can feel in your gut. Leverage turns normal volatility into a guillotine. If you own a house with a manageable mortgage, a price drop hurts, but you can wait. If you own that house with a fragile loan that resets higher, or if you bought a second house using a home equity line from the first, the drop doesn't just hurt. It kills. The same is true in investing. A leveraged position doesn't give you more upside. It gives the market permission to destroy you fast. In 2008, smart money escaped by refusing to be margin called by reality. Now, let's zoom into the moment the public finally realized something was wrong. The early headlines were subtle. A few mortgage lenders failed. A few funds wrote down losses. A few institutions wobbled. Most people shrugged. After all, the stock market hadn't collapsed yet. Housing had never fallen nationally in modern times. That was the line. But behind the scenes, something terrifying was happening. The value of mortgage-backed securities became uncertain. And when value becomes uncertain, trust disappears. If I don't know what your assets are worth, I don't lend to you. If I don't lend to you, you can't fund yourself. If you can't fund yourself, you sell assets. If you sell assets, prices drop. If prices drop, everyone looks weaker. That cycle is a vortex. This is the dangerous part. The crisis feeds on itself. Smart money watched this vortex form and asked one question. Who is most exposed to forced selling? Who is funding long-term assets with short-term debt? Who is hiding risk off balance sheet? Who depends on normal markets to survive? And then they moved away from those names. Sometimes they shorted them. Sometimes they simply refused to be their counterparty. That refusal is a weapon. Meanwhile, everyone else did what humans do when fear hits. They froze, or they panicked late. They sold after losses were already massive. They pulled money from funds at the worst possible time. They moved into safe instruments without understanding that safe can become illiquid if everyone tries to run through the same door. But here's what nobody tells you. Smart money also made money by buying when the blood was deepest. Not just after the first drop. After the forced selling. After the capitulation. After the point where people weren't selling because they wanted to. People were selling because they had to. You've seen this in your own life, even outside finance. The best deals come when someone is desperate. In 2008, desperation was everywhere. Homeowners were underwater. Banks were hoarding cash. Businesses couldn't roll debt. Entire countries trembled. If you had cash and the ability to wait, you could buy assets at prices that would look unreal a few years later. So the full smart money story has two halves. Avoid the guillotine early, then become the buyer of last resort when everyone else is forced to dump. Let's get specific about how they avoided the guillotine. One strategy was simply reducing exposure to financial stocks and highly leveraged institutions. Another was rotating into assets with lower default risk and higher liquidity. Another was using derivatives to hedge downside, put options on stock indices, for example. But the most important move wasn't a particular instrument. It was a mindset. They treated the world as fragile, not stable. Fragile means small shocks can cause huge outcomes. Fragile means the system can look calm while stress builds underneath. Fragile means you don't get to react after the headline. You have to position before the headline. And here's where the story gets uncomfortable for regular people. The average person didn't have access to the same information, the same tools, or the same incentives. If your 401k is auto-invested, you're buying every month regardless. If your home is your main asset, you can't just rotate out of housing. If your job depends on the economy, you can't hedge your income stream with a swap. And that's why crashes hit ordinary people hardest. They are forced participants. Smart money is often an optional participant. This doesn't mean you're doomed. It means you need a different framework. You can't play the same game on the same terms. You have to play a game that fits your reality. But before we go there, we need to understand the final betrayal of 2008, the part that made people feel like the system was rigged. When the crisis peaked, governments and central banks stepped in. Bailouts happened. Emergency lending facilities appeared. Rates were cut. Liquidity was pumped into the system. The goal was to prevent a total collapse. And you can argue that it worked because the world didn't end. But the distribution of pain was brutal. Many households lost homes. Unemployment spiked. Retirement accounts were hammered. And then, within a few years, markets recovered, often faster than wages did. So if you were wealthy enough to hold assets through the crash, or to buy during it, you benefited enormously from the rebound. If you were forced to sell, you locked in loss. That's the simplest explanation of why smart money escaped while others got crushed. They had the ability to wait, and the ability to buy when others couldn't. But here's what nobody tells you. The rebound wasn't just the market being the market. It was the system being reflated. When central banks flood markets with liquidity, asset prices tend to rise. That benefits people who already own assets. If you don't own many assets, you don't feel the recovery the same way. You feel higher rent, higher costs, and a growing gap. This is the moment people start whispering. Maybe the game is designed to reward the people closest to the money printer. That feeling is why 2008 still matters emotionally. It wasn't just a crash. It was a lesson about power, about who gets rescued, who gets blamed, and who gets told to be responsible after doing everything they were told. Now let's bring it back to the question that matters to you. What does this mean for your money, your job, your future? If you weren't in the room in 2008, you might think smart money had a secret formula. But the secret is less mystical and more brutal. They managed risk before returns. They treated leverage as a threat. They cared about liquidity. They questioned ratings. They tracked incentives. And they understood that when panic hits, the rules change. So how do you apply that without being a hedge fund? Start with the idea of fragility. Ask, where are you exposed to something you can't control? If your entire net worth is one property in one neighborhood, that's concentration risk. If your income depends on one employer in one industry, that's concentration risk. If your investments are all in the same kind of asset, that's concentration risk. Smart money diversifies not to be fancy, but to avoid being trapped. Next, understand leverage in your life. Debt can be useful, can also be a trapdoor. The question is not, is debt bad? The question is, does this debt force me to sell at the worst time? A mortgage with stable payments you can afford even if life gets messy is different from a loan that depends on everything staying perfect. In 2008, people didn't get crushed because they owned homes. They got crushed because they owned homes with fragile financing. Now, liquidity. Liquidity is the ability to act. It's not just cash in a bank account. It's the difference between I have options and I have to accept whatever the market gives me. Even a small liquidity buffer can change your behavior in a crisis, can stop you from panic selling. It can let you pay bills while you search for a better job. It can let you buy something valuable when everyone is dumping. And then there's information. You may not have access to Wall Street's private data feeds, but you can cultivate a simple habit. Don't just watch prices. Watch conditions. Watch lending standards. Watch how easy it is to borrow. Watch how excited people get about can't lose assets. Watch for narratives that sound like gravity has been suspended. Because the most dangerous phrase in finance is some version of, this time is different. Now let's build the climax, the moment all these threads collide. In 2007, the machine is humming. Loans are being issued. Securities are being sold. People are celebrating. In 2008, the machine seizes. Defaults rise. Mortgage securities wobble. Funding markets tighten. Institutions get nervous. Nervous becomes afraid. Afraid becomes panic. Panic becomes a global run on trust. And then you see it. The same people who told you everything was safe are suddenly telling you they need emergency help. The same institutions that privatized profits are socializing losses. The same voices that mocked the skeptics are now begging for liquidity. It feels like a betrayal because it is one of expectations. But smart money, the kind that survives across decades, doesn't build plans on expectations. It builds plans on incentives. It assumes that if a system can hide risk for profit, it will. It assumes that if leverage boosts returns, it will be used until it becomes dangerous. It assumes that if everyone is rewarded for pushing the party forward, the party will go on until the floor collapses. So when the floor collapses, smart money isn't surprised. It's already positioned. This is the perfect storm. Leverage forces selling, selling crashes prices, crashed prices trigger more selling, liquidity evaporates, trust breaks, institutions fail, governments intervene, and the survivors, those with cash, hedges, and patience, pick up assets from the wreckage. And here's the gut punch. The reason it works is because most people can't do it. They don't have the cushion. They don't have the time. They don't have the nerve. The system extracts that limitation and turns it into opportunity for those who do. So what's the single decision that separated crushed from untouchable? It wasn't being smart. It was refusing to rely on the world staying normal. It was building a life and a portfolio that didn't require perfect conditions. It was choosing resilience over maximum returns. Because in good times, the biggest returns often come from taking the most hidden risk. In bad times, hidden risk becomes visible, and visible risk becomes a price tag. If you want a mental model you can carry forward, it's this: every boom is a story, and every story has a point where it stops making sense. Your job isn't to predict the exact page number where it falls apart. Your job is to notice when the story requires magic to stay believable. When your neighbor buys their third property with borrowed money because real estate only goes up. When companies take on mountains of debt because rates will stay low forever. When investors stop asking what something is worth and start asking only how fast it's going up. That's when you should hear the smoke alarm. And if this opened your eyes, don't just watch the markets, watch the incentives. Watch the leverage. Watch the liquidity. That's where the truth lives. Because the next collapse won't look exactly like 2008. It never does. But the mechanism rhymes. The machine changes costumes. The human behavior stays the same. If you want more stories like this, where we dissect the hidden wiring behind the world you live in, subscribe and stay close. And in the comments, tell me, what do you think is the next too big to fail illusion we're all being sold right now?